Okay, so today I'm going to, my presentation is basically on the power of one. And it's a really great technique to use to make, small changes in a business regularly so that you're on the right direction. Okay, so what I'm going to talk about today is the concept of the power of one. I will quickly cover the 4 chapters in your financial story. Every business has a financial story. So understanding what those chapters are is really important. I'm going to talk about the 7 key levers in a business. And then we're going to go through a work example, and that will show you, the real power of the power of one. Excuse the pun. And then we can have some questions. So the power of one is basically the code of your business. What we're looking at is it shows the impact of a 1% or a one-day improvement on 7 key areas of your business. And we look at how that affects both your profitability and your cash flow, and then ultimately the value of your business as well, because every improvement in your business is an improvement in the value. And we all know we're not really working for love, although we might love what we do. We're basically here to build an asset to increase our wealth as well. All right. So what we use at Clearpath Accounting is we use software called Cash Flow Story, and that was co-founded by Alan Mills. And we use that to help our clients understand their financial story. It helps me improve the way I talk about their finances. So it improves our art of telling a story, and it helps to unlock any financial blind spots in the business as well. So it's a simple and consistent way that we can help our business owners understand how they're going and where to make the improvements and what is the most powerful improvements to make. So there are 4 chapters in your financial story. The first one being profitability. And we all kind of know this chapter. This one includes your revenue, your margins, which includes your cost of sales, your overheads, which are your fixed expenses, and then your earnings before income, interest and tax, basically your profit. All right. So that's story number 1. Story number 2 is your working capital. So this is the cash that you need in your business to manage your day-to-day, performance of the business. So it includes your receivables, your stock or your inventory, your work in progress, and your payables. So if your working capital is low, you run the risk of running out of cash to finance your business, all right? And if it's healthy, then you're in a good position to grow your business if that's what you wanted to do. So the 3rd chapter in the financial story is other capital, and this includes fixed assets and liabilities, all right? So most businesses require assets to generate a profit. Now that can be in varying degrees. For instance, a excavating business, they've got a lot of expensive equipment, and that helps them build profit in their business. There's a lot of outlay for their fixed assets. But in a professional service, basically you need a computer and a bit of software, and you're on the right track for producing profit. All right, so it's varying degrees of that investment. But you need to understand what your return on investment in those assets are, and you need to understand your level of borrowing as well. And then the final chapter is your funding, all right? So this is the result of the first 3 chapters. So chapter 1, your profitability, your working capital, and then your other capital. Now, if you have a surplus, that's really great. That means you're doing everything right, depending on that level of service. It could be just a positive result. But basically, you can use that surplus, to reduce your debt, pay out dividends to the owners, and it can also help you finance growth in your business as well. But if there's a shortfall, so for every dollar that you're earning, you're actually producing a negative result, obviously that needs to be turned around really, really quickly. So how you need to think about, how are you going to fund this shortfall? Is it cash reserve? Have you got any cash reserves you can access? Do you need to borrow from the bank? Do you need to introduce more capital into the business? How are you going to fund it? So that's a really important question. So the Power of One basically only really covers the first 2 chapters, so profitability and working capital, but it looks at 7 key levers in a business and how each of those levers, which ones to pull will give you the most effect to improve the profitability and the cash flow in the business. So the 7 key levers are your price, your volume, your cost of sales, and your overheads. So that's all related to chapter 1 in your profitability. And then the other 3 levers are your receivable days, your inventory or your work in progress days, and then your payable days as well. All right, and they affect your working capital. All right, so that's the cash in your business. So what I'm going to do, I'm going to stop sharing this slideshow, but then move on to the software that I'm using. So I'm just going to end that slideshow there. Can everyone see the Power of One? I'm hoping you can. Just interrupt me if you can't.
Yes, we can see that.
Great. Okay, so as we said, the Power of One is we're gaining a better understanding of the relationships of the 7 key drivers in your business that relate to that can affect your profit and your cash flow, plus the value of your business. So this is something that I go through with my clients for my advisory and my coaching clients. We go through the Power of One every quarter. All right, so it just shows them how we're progressing with our goals. Oh, sorry, I'm just moving the screen. Let's just go back. Okay. Whoops, sorry. I'm just lost it. Here we go. All right, so the Power of One. As we said, it's a code of your business. It shows the impact of a 1% change or a 1-day improvement on the 7 key areas of your business. So we're going to talk about, and this helps you understand your code. So with profitability, we understand there's 2 critical relationships that drive profitability. The first, as we talked about, was your price and your value. So we're going to look at the impact on a 1% increase in price and a 1% increase in volume and what that does to your profit and your cash flow. So you can see on the left-hand side, this is the impact on profit, all right? And the right side shows the impact on your cash flow. So we can see that if for this particular business, so Sam's Plumbing, if they had an increase of 1% in their business, this generates a 1.5 times more profit than if you had an increase in volume. All right, so the right-hand side shows the 1.5% more profit, and it's 1.4 times more cash flow. So the second key relationship for profitability is your cost of sales and your overheads. We want to have a look at if there was a 1% reduction in cost of sales or a 1% reduction in overheads, what will that do to your profit and your cash flow? So again, for this business, reducing their cost of sales by 1% generates 0.5 times more profit than if they reduce their overhead. So this gives us an idea of what's more effective in the business. And obviously it's 0.4 times more cash flow if they reduce their cost of sales. So with working capital drivers, as we said, there's 3 key drivers there. These drivers only affect your cash flow. They do not affect your profitability. And they're receivables, inventory or work in progress, and then your payables. We want to have a look at what is a 1-day reduction in receivables or a 1-day reduction in inventory or work in progress, and a 1-day increase in payables. And what does that do to your cash flow? So for this business here, if there's a 1-day improvement in the receivables, so you collected your money 1 day faster, that would generate $1,648 more cash flow in the business. And it also and that also relates to inventory as well. So if they sold their inventory 1 day faster, it also produces $1,648 more cash flow in the business. And then slowing down the payable, slowing down payments to suppliers. If you slowed it down by 1 day, you would generate 512 more cash flow. Now that's not one of my favorite techniques, but it's there available for a business if they're really in difficult cash flow situation. So let's have a look at the summary here. So we can see this is just your 1% or 1 day improvement. So 1% price improvement, that can generate $5,600 more cash flow, but $6,000 more profit. If this business increased volume by 1%, it's $3,800 and then $1,400 for profit. Cost of sales, if they made a 1% saving, it's $1,700 compared to $1,800 in profit. And then we've got the overheads. There's a 1% improvement in overheads, then it's $3,900 for both cash flow and profit. And then we've got receivables, inventory, and payables. So we can see basically from that simple 1%, this business can improve the cash flow by $18,955 and also its profitability by nearly $16,000. So you can see on the right-hand side that the top part shows your improvement, where that business was sitting in regards to their cash flow and where the business was sitting in the operating profit, and then what improvements these adjustments can make to both of those figures. So this is the part where I find is really great for clients. We now customize the conversation. So if I ask the client, when was the last time you put up your prices? Now, if they say more than 9 months ago, then I say it's time for another movement. All right. So I would say, this client might say, well, yeah, Suzanne, I'm happy to put in a 5% increase. Suddenly we can start talking about their business and how it will affect it. These changes will affect their circumstances. So we can automatically see that the cash flow is now $28,000 improvement and the profit is 30 by doing that one simple strategy. Now with volume, I've got clients that say, no, I don't want to make any changes in the volume. We're at peak capacity. I don't want to take any more work. And then I've got other clients that say, yeah, I reckon we could take probably 10% more work on. So for this example, that's a really strong strategy for them. And so it brings in another 38 in cash flow, 41 in profit. And sometimes we've got to be really, really careful. There's some businesses at their current state that if they increase their volume, that actually can create a negative because they haven't got their foundations of their business sorted out. So it's really important. If that starts to get negative when we increase the volume, there's a real fundamental issue in the business, and that needs to be fixed straight away because they're actually going to grow broke. So that's where that saying comes from. With your direct cost, you might negotiate with your suppliers and say, look, I spend $500,000 with you per year. I'd like a 2%, saving. So you can ask that question. And when we're talking about small amounts, it's easy to have that conversation. Now, I've got a client who, has a VA, and he's actually a plumber as well, but he has a VA, and her job is to measure every time they need supplies, is measure between two main suppliers. Now, he says he can save up to 20% on average, all right? So when we're looking at that strategy for a business like that, we can see massive savings. So that's one of her main jobs, is to make that comparison all the time. Now, I wouldn't say that that's very common. Usually, for this instance, we might talk about a 3% saving. So you're negotiating that, or you're recovering, you're looking at your wastage. There's other techniques rather than just discussing price with your suppliers there. With your overheads, if this, for instance, when a business is growing, I would highly doubt that there's any savings in overheads at all. Usually it costs you more to grow a business. So we might say, well, look, 5%, I need to spend more money to grow the business. So if I'm going to increase my volume, it might mean that I've got to spend more on marketing or a salesperson or something of that nature. So often I'm very skeptical in improving overheads for a growing business. But I would recommend that you review your costs. You might save on insurance, you might save on your telephone, whatever that may be. So with receivables, if someone's in control of their receivables, they might say, no, I'm totally in control of it, Suzanne, don't make any change at all. But generally, there are some businesses that are not in control of that. So they might say, look, a 2-day improvement on my receivables. I'm going to be really strategic and collect as soon as I possibly can. And some people have got it blown out beyond belief. And that's another conversation, basically. But you can see just a 2-day improvement will bring in $3,295 for this business. Work in progress, same deal. I might say to you, look, if you've got stock, do you think you could get it out quicker, by 1 day? Is it 2 days? Is it 5 days? But at this point, I'm just going to leave that at 0. And then payables, it's not my most favourite strategies. I like my businesses to be on top of their payables. In fact, some people might want to improve the number of days that they pay their payables because they're just stretching it out a bit long. So we can see just by moving the dial slightly, we've made a substantial impact on this particular business. Cash flow 54,000 and profit 57,000. And we can see the result on the right-hand side here. So then we just talk about the top actions: increase price by 5%. We want to get that extra 10% sales. We're going to increase leads and sales conversion. And I might say, well, I'll send you a list of ideas or techniques on how to do this. And point number three, ask your VA or someone to compare pricing of your standard costs to ensure you're getting the better deals. It could be one of the actions. And then be more proactive in collecting receivables. So once that's done, we basically can then download the report, and it's a really easy and clear report for the client. It shows their current position, both cash flow and operating profit wise, a few increases or improvements in the business that are realistic for their circumstances, and then the adjusted net position. Now, this is on an annual basis. They have, these figures are adjusted for annual improvement. So it's an improvement of $54,000 for the year. All right. And then you've got your actions, your actions listed at the bottom of the screen there. Okay. So basically that is, I find that is such a great conversation. It's one of my most favorite conversations with the client. It helps them, change their business in little bite-sized pieces instead of making major changes. All right. Now, For this instant, the highest thing here is increasing the volume at 10%, but it might be 2%. It might be just turning that dial that small amount. So yeah, so that's the cash flow story that I produce for my clients. I think it's a really powerful conversation. And if anyone's got any questions, then that would be great. You can unmute yourself if you like.
So I use the same software, and one of the strategies I also do is, very often people put on promotions and discounts. And I use this as sort of saying, okay, so if you are going to give a 5% discount, how much extra does it mean you have to sell just to break even on your profitability? So you can use it in that way. So you're actually helping set targets around, around the pricing strategy or the volume strategy with this software. It is fantastic software, and thank you for showing it to us.
No, that's okay. This is a one little bite size of it. You can go into a lot of depth into it with the business.
Absolutely.
In regards to their health. You know, how much funding have they got? We talked about that in chapter 4. You know, what's their funding? Is there, as they grow, are they going to, be in a negative situation? So it's, as I said, it's really powerful stuff, but it makes it and the clients understand it. It's a clear story, and it's just little dials, little changes. We don't have to change the world overnight, especially during COVID. Now, these changes can be made during COVID, maybe not in lockdown, but coming out of lockdown, we want those businesses to take action. The sooner they take action to get back to at least normal, their normal standard, if not better, then they're going to come out all right. Any other questions?
I guess I probably have one question. I guess something that would then need to be factored in is, everyone would love to be able to click their fingers and get a 10% increase in volume.
Yeah.
But typically there might be some marketing costs associated with that or something like that. So I guess that would then drop that
overhead. So that's where,
down.
Yeah, that's right. So
okay.
that's where we look at. So your marketing is part of your overhead. So realistically, a growing business is going to incur more costs. So I'm very wary about really the savings on overheads for a growing business. Okay. And that's why I said, look, you're actually not going. You're going to spend more money here, but you can see that spending more money is going to still be okay. You're still making those improvements in the business.
Yeah.
All right.
Yeah.
All right.
The other thing that you can actually use this for is an example, and Alan Mills does take it through, is in terms of wastings. How does this work in terms of, is your business wasting resources, good management, things like that? So if your revenue grows by 5%, how much has your accounts receivable grown in proportion or below? How much has your work in progress grown in proportion, above or below? And if your accounts receivable or your work in progress have grown more than your revenue increase, it's actually a wastage and reflects on your management style. So you need to actually go back and work on things like that. So
yeah, so this is a high level conversation. We're starting with a high level. Then we can drill down and say, well, what does that price increase look like? Is it for every service? Is it just in general? Is it specific? Then we're looking at your volume. How do we get more leads? And then that's, we talk about those little things. So this is high end, but we know suddenly it gives the client the confidence to say, well, actually, if I do this 5% increase, I know it's going to bring in another $30,000 in profit. And that hits the bottom line straight away. So it gives them permission. And that's probably all a lot of people need, is permission to make the changes in their business with confidence. All right. Thank you, Anil. You can stop recording probably.